All right, Brian Tessia here, Remax Advanced for Realtors. Thanks very much for once again joining me with my BeLive interview. And today I'm super excited. My guest is going to be Leslie Raymond from Holland Mortgage. She is the lender that I use consistently. Good morning, Leslie. Thanks for joining us.
Good morning, Brian.
So tell us a little bit. I do this with all of my guests. We need to know, my audience needs to know, who are you, a little where you came from, and where are you now?
Okay, well, I started 19 years ago as a loan officer. And when I originally started in this business, we did everything from taking the application to processing, ordering the appraisal, title, and just about everything with the loan. Right now, as you said, I'm currently with Holland Mortgage, and I've helped thousands of buyers, first-time buyers, and people who are buying their second home, help them find the right loan for them.
And Holland Mortgage is a local Pittsburgh brokerage, correct?
That is correct.
Awesome. All right. So we've got a bunch of questions that people sent in and a couple we composed. So question number one is, what will a lender look at when qualifying me for a mortgage if I'm a buyer?
Yes. Okay. Well, the first thing they'll do, or I will do, is run your credit. We'll run all three credit scores, and most lenders use the middle credit score. Then we will get your income and your work history. And that is how we determine how much you qualify for.
Awesome. I know this question here is big, and I always get asked this a lot whenever I am out in the field with a buyer and we're looking at houses, or I just met them online, and that is going to be, can I have multiple lenders? Because I'm a buyer and I'm searching for different lenders and I'm interviewing them. Can I have multiple lenders hit my credit, run a credit check on me? Is that going to pull it down? Am I going to no longer be qualified for that house?
Well, that's probably the question that I get asked the most. Okay, so they can go right online to the Consumer Finance Protection Bureau, and it's written right on there. You can have as many credit pulls as you want, as long as they're all done within 45 days of the very first pull. So no, it does not bring your credit score down, according to the Consumer Finance Protection Bureau.
That's good to know. I mean, I always try to stay on my lane whenever people ask me that, but I definitely want to make mention of that because that's very good. And a lot of buyers make a lot of mistakes because they think they're just, they got to go to the first lender they meet because they don't want their credit score down. So
I hear that every single time.
Thanks for answering that question. That's actually awesome. So next question is, I'm a buyer and I'm out there and looking at houses. What is the best type of loan for me?
Well, after the interview process, which, I will know your age, I will know your income, I will know, how much money you have saved in the bank. That will determine, which type of loan for you. There's all different types of loans. The most popular one is the FHA loan. That's the one where you only have to put 3.5% down, and you're allowed to ask the seller to pay 6% of your closing costs. So you don't have to bring as much to closing. So that's probably the most popular one. The drawback with that is the mortgage insurance stays on for the life of the loan. They changed that a few years ago, but it does take you quite a few years to reach that 20% equity, before the mortgage insurance comes off like a conventional loan. So depending on your age, usually they say the average buyer, at a younger age stays in a house about 10 years. And it takes about 9 years on a conventional loan for the mortgage insurance to come off.
Right, and we're not going to dive in to drill down too much on what an FHA loan is, but do you see what type of buyer do you see usually using an FHA type of loan?
Most of the time it is a first-time home buyer, and most of the time it's because they don't have enough funds to close. They take advantage of the lower down payment and the 6% seller assist.
Right, and let's just say they start out with an FHA loan and then maybe 2 or 3 years later they're in a better financial position. Can they refinance out of that type of loan?
Yes, they can.
All right, so they can maybe get a lower interest rate 5 years down the line. So it might not be a bad idea to get, be a first-time home buyer. You want to get out of that renting, take advantage of the FHA, and as income improves, maybe switch out of that.
Absolutely. 9 times out of 10, people are shocked to see that their mortgage payment is either less or the exact same as their rent payment. But, there's all kind of other things that come with owning a home, but the payments are pretty similar.
That's actually awesome. And another question is, if I do want to refinance my loan and restructure it, would I reach out to you if you're the one that originally did that?
Absolutely, yes.
Perfect. Awesome. Okay. Moving on. So how is the interest rate determined? And I know there's something called a rate lock. What is a rate lock? When does a rate lock happen? Can you elaborate on that for our first time buyers?
Yes. Okay. So they're really two different questions. First of all, the rate lock happens when you actually have a signed sales agreement. We cannot lock a rate, prior to that. So you can lock a rate 30 days, 45 days, 60 days. The lower you lock, the better the pricing is. So, we determine that once we get the sales agreement.
Right. So that's why you always ask me for a sales agreement whenever sign a fully executed sales agreement whenever we have a buyer that has put an offer in on a home.
That is correct. And then the second part of your question, the rate is determined. It's credit score, credit score, credit score. That is the biggest thing that determines the rate. The other thing is your loan to value. How much am I putting down? That will also affect the rate.
Right. Yeah. Again, when I'm out in the field, I have a lot of buyers ask me, what's the credit rate? Well, I mean, there's so many outside factors that are going to affect that. And, listen, you talked about it. We don't want to give any advice on checking your credit, but there are different websites out there where you can check for free your credit score once a year. So that might not be a bad idea knowing.
Absolutely. I would do that once a year because when someone calls me, I will ask them, do you have any idea what your credit score is? So that gives me a gauge because if they're telling me their credit score is in the 400s or 5, there's no reason to do another credit pull. But, usually they're pretty sure of what it is if they've run it through, one of the free credit scores.
Right. And I know there's been times where people have applied for a mortgage and their credit wasn't quite where they wanted. Our clients that we did together, and we recommend them to different credit cleaners or different services that can help clean up their credit as well.
That's correct. And it's best to go with a company, like a credit repair company that someone who has used them before, because there's a lot of good companies out there and there's a lot of bad ones out there. So usually if your credit score is not too bad, you can get your score up pretty quickly.
Right. So I'm going to give a free plug to Paul Ritter of Credit Investigation Services, CIS. Years ago, I decided to start working with him to help my buyers, and my credit was good, but I figured I might want to try the service out anyway. And I tell you, it was pretty cool. He would send out letters on my behalf there were things on my credit I didn't even know was there. I had been paid off a long time ago, but just stuck on there. So he would create a letter. He had a template of the letter, and he would send it out. And I can't believe how much he pulled my credit score up. I think it was an 800. He pulled up like an 890 or something like that. So, and it was only a couple $100, and you paid per stage.
You paid monthly, right? And I've known people who have used him also with great success.
Right. So maybe I'll do a BeLive interview for the buyers that are watching this interview at a different date, and we could help you guys out with that. Okay, moving on. So there is this thing called a mortgage payment. And I know a lot of times my buyers are like, oh my God, how much is the taxes? I have to pay those extra. So elaborate a little bit on what does my mortgage payment look like? What is inside? What does it include? Okay,
well, it'll be broken down. Okay, so the very first part will be your principal and interest. Quite simple. The second part will be your homeowner's insurance, and you'll shop around, for your homeowner's insurance. You'll tell me who your agent is and their phone number, and we will call them and we will pay them from your escrow account. The third thing actually are your property taxes. Now we get estimates, from online, but the taxes, until we actually get that tax cert from the title company, we can only put an estimate. The fourth thing is your mortgage insurance. If you're not putting 20% down, you have mortgage insurance. And I'm talking about both FHA and conventional, but no matter what you put down on FHA, you still have mortgage insurance. So, if you had 20% down, we wouldn't do an FHA loan. And then there's the total.
Great. So you're talking in big terms, and I love that because that shows the audience that you are experienced. But I'm going to rewind back when I was 25 years old, and I remember they were talking about principal, interest, and I was like, I just got to pay this. I don't really know what the heck this is. So can you just tell the first-time buyers that are like maybe 22, 23 years old that are watching, what is principal? What is interest?
Okay. Principal actually goes to the payment of the actual loan amount.
Right.
The interest is what you're paying because you don't have the money. That's what the banks are making. It's the interest.
That's the bank's profit.
And when you start out in the very, very beginning of your payments, most all of that money is interest. It goes to interest. Like you will get an amortization chart that will show over the 30 years of the mortgage how much goes to principal and how much goes to interest. So as you pay, as the years go by, more goes to the principal to pay your loan in full. Yes.
And that is really good. And I'm glad you talked about that. A lot of times, I don't think a lot of people understand that the first X amount of years, of the two numbers, the biggest number is the profit that's going to the lender, which is, we call that interest.
That's right.
And that's because they want to make sure they get their money back if something would happen and you would quit paying. So that's a good thing. And there's something called an amortization schedule. Every time I sit at a closing, the closing agent will put it out and be like, you don't want to look at this if you don't have to, because it shows the whole 30 years the interest you're paying, and the number is astronomical. So excellent way to drill down on that. And we talked about interest, we talked about principal, taxes. So every time, and I'm going to take over just a little bit here, Leslie. Yes. Anytime we go and look at a house and you identify something that you're interested in, I always recommend speaking to your lender if it's not, Leslie, and try to get a good faith estimate, because we can't give you an estimate of what your monthly payments would be and what you would need to bring to closing until we have identified a house, because every house has different taxes, and the lender needs to know what the taxes are in order to give you a real tight ballpark on what your monthly payments would be. So, okay, good stuff. So we're going to move on to what is an escrow account, which kind of tails off of what we've been talking about here.
Okay, so when I am calculating what you need to bring to closing, I will usually escrow about 12 months of property taxes. We usually escrow about 14 months of homeowners insurance. Now, why the lenders do this, it's because if you would default on your loan, at least they have the homeowners insurance and they have the property taxes paid 1 year in advance. Now, people have asked me, well, what happens to that money? If you sell that house, you will get that money back once it's paid off. So it's just sitting there in a third-party account.
Right, and I can confirm that because I used to flip houses and obtain mortgages to do this. So it would take a good 6 months, and you really kind of have to follow up with them, but you will get that interest you prepaid up front back. Now, is this a law, or is this just a rule that all lenders have, Leslie?
You mean to pay the money back or to escrow?
No, to escrow the whole year up front if you're obtaining a mortgage.
Yeah, you know? I am not 100% sure about that. Okay. I do think it has something, it does have something to do with, they all have to do it. Let's put it that way. So I don't know that 100%, so I'm not going to answer that one.
Right, yeah. I've never seen it not done, but I know it's just automatic.
Well, on a conventional loan, though, if you put 20% down, you can ask for an escrow waiver.
Oh,
now,
wow.
Yeah, you will get what they call a hit in the rate. So the rate might be 1/8 of a point higher to have this privilege of doing it on your own. But they won't do it on an FHA loan. It's you have to escrow, and if you don't put 20% down on conventional, as far as everyone I've worked with won't do it.
Right, and honestly, it's just easier to have an escrow account, and Absolutely. I mean, they can automatically. Some people are funny about having banks go into their account and take the money out, but I mean, anytime I had a mortgage, it was just so much easier to not have to worry about writing the check out and all that.
That's
and sometimes
exactly right.
Yeah,
and
so
I do recommend that, especially for first-time home buyers. Then you don't have to worry about putting money aside to pay your taxes and homeowners later.
Right. And a side note, if you're doing a cash deal, you do not have to, because I know I have to do the good faith estimate as an agent instead of relying on the lender to give me the numbers. In a cash deal, you do not have to pay insurance a year up front, nor the taxes up front. So there's a slight advantage there.
That is correct.
But you do have to stroke a check for the taxes, however you want to do that, annually, quarterly, et cetera.
Right. But again, cash deals are rarities.
Yeah, that's for sure. At least in Pittsburgh. I don't know about everybody else watching. Okay, so moving on. I have all my money with a local bank, and I get this a lot. They just want to use their local bank, and I have to tell them, hey, listen, you tell me, Leslie, why is that a mistake?
Okay, well, when you call a local bank, they have their rates only. So you're dealing with just one bank. And usually at local banks, from what I'm told, you're dealing with a number of different people. At Holland Mortgage, when I look up a rate, I have probably 10 or 15 banks that come up, and then I could take advantage of the best rate. The other thing is banks differ according to, like what their niche program is. Like I will know like this bank has a better rate if you have this issue, or this bank, is better to go with, if I'm a first time home buyer. So, you've had problems, with local banks. I've had people that I've done mortgages for after they've gone with a local bank and stopped the process. So that the main advantage probably is rates.
Right, and I tell all buyers this, they just have the bank just has one product, and they're going to try selling you their product. It's just
Right.
like if you're going to new construction, you have a salesperson sitting at the desk, they're just going to try selling you on their builder's product. They're not going to look, and as an agent, I will show you all kind of other houses and try to find the best thing for you. And that's not saying that the bank's rate won't be the best. Sometimes they waive all kind of their fees and everything else.
That is correct. That is correct.
Okay, moving on. What credit score do I need to qualify? What's the ideal credit score?
Okay, well, the ideal credit score to get the best rate is 740. Okay, the highest you can get in the 3 credit bureaus is 850. We use the middle score. Now, I've seen loans get approved at 580. I've seen 600, but you really have to have compensating factors. If your credit score is that low, there's usually something on it that the lender's not going to like. But if you have a great job history, you have reserves in the bank, and maybe you had a medical illness and you had to take off work and you just got behind, we usually can do a letter of explanation, and get something like that approved.
Right, and that kind of goes back to what we were talking about with the credit repair service as well. So that minimum credit score of 740, does it ever change over the years, or is it always a standard level?
Well, I can only answer for the places that I've worked at.
Gotcha.
And let's say they have levels. So 740 and up, you get the best rate. Okay, say maybe 680 to 740, it might be an eighth of a point less on the rate. So everybody structures that differently.
Oh, gotcha. Okay. You're starting to talk Chinese to me, so we're going to move on. All right. So how do I know how much I can be approved for? Again, I'm going to go from a first-time home buyer's mentality. I'm just deciding to buy a home, and research has shown, the National Association of Realtors has done studies that says it takes 18 months from the thought goes into a buyer's home to buy to the day they close. So the thought goes into my head. How do I know how much I can be approved for?
Well, basically, it's a math calculation. We take how much you make now, your current income, we take versus all your current debt, and then your new housing payment. And that's how we come up with the debt ratio.
Right. So if I'm in a cash business, this is not a good thing for me.
It is not. It is not, because, if you don't turn it into the IRS, you can't use it.
Right. All right. So moving on, and this is my last question I have for you is, what can go wrong during the process? And I know the answer for this already, that could cause a buyer not to close, but I want to hear it from you.
Okay. Well, people ask me this all the time, because as you know, the closer it gets to the closing, the more they want me to say, I guarantee you 100% you're going to close, and I can't do that. So basically, it's pretty big things that happen. Okay, the biggest one, and I have had this happen one time in 19 years, you lose your job. Okay, well, I started to work with a buyer, and she didn't tell me she lost her job. And I said, well, why didn't you tell me? She says, because I wanted to refinance. So, oopsie. She didn't get a loan. Okay. Yeah. The second thing is if you go out and make major purchases, because a couple days before closing, well, actually 2 days before closing, they do a verification of employment. Sometimes it's the day before. They make sure you're working there. Throughout, like as we get closer, it could be like 2 weeks. They might do a check a week before, 3 days before. They check to see if you opened any new credit cards or made any major purchases. So if you did, which a lot of people have, we have to add that back into your debt ratio. Now, if your debt ratio isn't bad, you're fine. But if you are very, very close to being over and not approved, that could kill your loan. So Absolutely. Those are the biggest two things.
Right. So basically what she's saying is, and a lot of people just don't understand this, is don't finance anything large. Some people will try to finance furniture because they're buying a
Furniture,
house, or
right,
finance a car or something
right.
like that. You don't want to take out any type of new debt, any type of new payment, so to speak, because that'll kill a deal. And for my sellers that are watching this, there's a lot of times when we get our listing contingent, they're like, woohoo, they pop the bottle, pop the cork. And I'm like, listen, until, for the reasons Leslie just said, until the day of closing, when you sign those documents, it is not a guarantee. Now, of course, there could be all kind of legal ramifications, but even that's a nightmare. There's no guarantee that you're going to close. So you want to just continue to walk the straight line, whether you're a buyer or a seller, until the very end of closing.
That's correct. And even an existing credit card, if you put, a whole lot on an existing credit card, that comes up also. So thank goodness a lot of my buyers, they'll call me and they'll say, hey, I have to get my car repaired. Can I do that? Yes. Something like that is fine. But again, it's major purchases.
Right. I was just going to say that, Leslie, if you are a buyer and you're in a mortgage process and you're closing on a home, whether it's Leslie or whoever, and you think you want to buy something big, even if you're not, there's no dumb question. Even if you're not sure, just shoot your lender an email and say, hey, thinking about buying a furniture set cash, or just putting it on my credit card. Can I do that? Let the lender answer that question for you.
Right. Or put it on mom and dad's credit card.
That's my favorite. How about if I put it on yours, Leslie?
I don't think so, Brian.
All right. So that's it. That's all we have. Leslie, I want to thank you for taking the time this morning to answer a lot of these questions.
You're welcome, Brian. We'll do it again.
All right, everybody. Thank you very much. If you want to, I'm going to rerun. I will record this and send it off to you. I'm going to post it. You can post questions below if you have any questions for myself or Leslie. All right, everybody, have a good day.
Thank you. Bye-bye.